Hi, everybody. It's Nate Scott with Windermere Real Estate. I'm here to answer a few questions that we keep hearing out there about COVID-19 and how it's affecting the real estate market. So I'm going to go over the four top questions we're hearing out there from our clients. First is, will the housing crash like 2008? Next, what is the market like today? What will the market look like when we come out of this? And finally, what will happen with housing prices? So starting with, is this housing market going to crash like 2008? The fundamentals of our market are very, very different than the 2008 fundamentals. I was listening to Matthew Gardner, Windermere's chief economist this morning, and he said something that struck a chord with me, and that was, we are in the middle of a health crisis, not a housing crisis. 2008, clearly, that was a housing crisis, and credit markets were a little messed up as well. So looking at this graph here, and this is historic data for the Mortgage Credit Availability Index, and what that means is the higher the number on this graph, the easier it is to get a loan. If you remember back in 2004, 5, 6, and 7, in that time frame, anybody could get a house loan. You didn't have to have a job. You didn't have to prove income. It was, banks were just handing out mortgages back then. Today, it's very different. It is difficult to get a loan. In fact, the credit score you need to get that loan is going up right now as we speak. Banks are tightening credit a little bit, but it is light years different than it was in 2004, 5, 6, and 7 in that time frame. So it's harder to buy a home. People who should not own homes are not getting them as opposed to back then. Appreciation is not crazy like it was in 2001 through 2005. We saw some, and these are national numbers that you're looking at. These last 6 years, appreciation has been much more modest, so we are not overinflating the values of the homes, though it does probably feel like that to some folks. Inventory, vast difference in inventory as well. 2007, we had a ton of homes on the market, so even though there was that appreciation, there wasn't the pressure from buyers creating that. Today, there's 3.1 months of inventory nationally. Looking at Anacortes' numbers, just to bring it to a local level, actually, I'll start with Skagit County. In 2007, it was 6.7 to 8.6 months of inventory, so a ton of homes, not enough buyers, probably. Today in Skagit County, 1.7 months. Anacortes back in 2007 was 8.5 to 9.5 months of inventory, depending on which quarter of the year you look at. And today it's 2.4 months of inventory here in Anacortes. So very different supply of homes on the market. Affordability has changed as well. So the percentage of income you can spend from a bank's perspective on your mortgage, back in 2006, people were spending a little over 25% of their income on a mortgage. Today, thanks to low rates and the last year and a half, 2 years of wage increases, 15.5% is what you need to typically to afford a mortgage. And in fact, I just saw an updated number because the rate drop that just happened, it was down to 14.8%. So you're spending less of your income on your housing costs today. Home equity, it's light years different today as opposed to back in 2005, 6, and 7. People were pulling every dollar they had out of their homes, so they had no backstop should there be a market correction. Today, it's very different. We are not pulling all that equity out. We are building home equity, so home owners are in a very enviable position as compared to 2006, 7, and 8. So that's kind of the answer to, is this going to be like last time? No, it's not. As for activity today, like what's the market today? Well, the rates which I've mentioned are so low that, these are historic low rates. They are allowing more buyers to enter the market. They're allowing sellers to sell and move up easier. And it's just like we just talked about, much more affordable to be a homeowner versus a renter. In the last 30 days, 31 new listings have hit the market in Anacortes, so there is activity out there. But if you look a year ago, March, there was 61 new listings in that 2019 March. So roughly half the listing activity is hitting the market than what hit last year. That does not mean that there isn't activity behind the scenes. There is. I've been talking to our agents, and there are a load of new listings that are prepping for the market, but they just aren't hitting the market, partly due to the COVID-19 concerns. In February, we had 30 homes go pending in Anacortes, as opposed to February 2019, when we only had 19 go pending in 2019. So we actually had more business happening in the real estate world this February, when the COVID started, and that was part of the concern out there at the time, than we did a year ago. March pendings, I'm expecting will be down to 2019. I don't compared to 2019. I don't have the final numbers yet, but it is going to be a lower number, probably half of what happened in 2019, maybe even less. And activity in general will be down for March and April, possibly now June, depending on how long both our local stay-at-home order is in place, and it's due to go away next Wednesday, not this Wednesday, but the Wednesday following. Fully expect that the governor is going to extend it and mimic what the president did by extending the national stay-at-home order he has. So I'm expecting that March and April, maybe even June, are going to be slower than normal. That being said, showings are happening, deals are being written. The governor did give some relief to the real estate community and opened up some avenues for showing properties and doing business. It's very narrow what we can do, and there are some very specific guidelines we have to follow, but business can happen right now. So post COVID-19, what's the housing outlook? That's the third question we keep getting. So supply and demand is going to remain out of whack. We have nowhere near the amount of housing we need to meet this buyer demand. The buyers are going to be there. They're there right now. They're looking online every day. They're asking us when we can get into houses and what's new coming on the market. And that's partially the interest rates that's driving that. But also just the fact that we have not kept up with buyer demand as a nation. We're so far behind in new construction and things like that. And that new construction will continue to lag. That's not going to change anytime soon. Builders just aren't able to build the entry-level homes we need. We're going to see a small surge of new listings hitting the market once the stay-at-home order is lifted. And again, I think it's going to be extended. It's not going to end next Wednesday. It's going to be another week or two, or possibly more, depending on this outbreak. But once that is lifted, we are going to see a bunch of listings hit the market. There's, like I said, I spoke with a bunch of our agents this week, and I was shocked by the number of agents who are working on listings right now, who have sellers that are ready to go to the market. They're just trying to time it as best they can with this stay-at-home order. So I believe this fall's market will look very similar to last year's market. That's assuming we're through the pandemic, stay-at-home orders, etc., and business is mostly back to usual. I think will be very similar to last year's market. Still supply and demand out of whack, but buyers out there buying homes and probably seeing multiple offers because of that supply and demand disparity. Personally, I'm thinking we're going to have a busier fourth quarter in 2020 and a busier first quarter 2021 than we would normally see in those quarters, because of all of this business that is getting pushed back due to the pandemic. People always get, job changes, have babies, and other things happen in their lives that force moves. So all of that's kind of hit pause right now. And there's a lot of people who are just pushing off their housing decisions for a month, 2 months, 4 months. And that's going to create, I think, a busier than normal fourth quarter and first quarter. All the economists I'm listening to are very giving positive news for 2021, and in fact the end of 2020. So one thing that could affect all of this, will affect all of this, and I don't know where this will go, and that is jobs. Jobs need to be there for people to buy homes. A week ago, so week ending March 21 here, Washington State laid off a little over 133,000 people were laid off within our state, and that's when our average, I think, is about 6,000 or 7,000 people per month get that layoff notice. So it was a huge jump, and that's going to be a hit. But if you look at the graph here, you can see that Washington State does not have it as bad as many states do. We're right kind of in the middle. So what happens with jobs will, of course, affect housing and the number of buyers out there. Like we all know, you got to have a job in order to afford a house. So that's one unknown. How quickly does the job market rebound? That fourth and final question, housing values. What's going to happen with our values? Are we going to lose values like we did in 2008, or what will happen here? And I don't think we will. Recessions do not equal a loss in value. Of course, 2008 is fresh in our minds, and that was a doozy, 19.7% loss of value across the US. And we all remember that. I mean, that's real and recent, so that's what's in our head. But if you look at other recessions, the last 4 before that, there was either a gain in value during the recession or just a very slight loss of value during the recession. So recession does not equal loss in value. The stock market. You guys have watched it go from almost, what was it, almost at 30,000 down to 20,000. That also does not equal a loss in home value or appreciation. During the S&P correction of 2001 to 2002, or I'm sorry, 2000 to 2002, during those years, every year homes appreciated. I fully expect that to happen now. We are already getting calls from people who are taking money out of the stock market and saying, I want to put it in housing, it's more stable. And you know, housing offers a relief to those markets. People do move from volatile markets into stable markets. I think we'll see that. We already have a supply and demand issue. So if we add some more buyers from the stock market, investment buyers, that is only going to create more of a supply and demand disparity and put upward pressure on pricing. Goldman Sachs, here's their GDP forecast. This is about a week old now, and things change every day, if not every hour. So this may be revised, will be revised a couple times as the year marches on. But they're looking at, after a whopper of a second quarter in terms of economic hit, they're looking at a rebound in the third quarter and fourth quarter. And like I said earlier, I think most economists are looking at 2021 as a positive year in terms of GDP growth. So I'm thinking that we're going to come out of this recession, and we are in a recession or at the beginnings of a recession, after a quarter or two, and we're going to see some strong growth in the future, including in housing. So that's kind of the quick, easy answers to those 4 questions, understanding that this is a crystal ball and no crystal ball is foolproof, but there's a lot of data we can go look back on, which we ran through some of that from past recessions or past events and apply those data points to today. In the end, our housing fundamentals are so strongly positioned for continued appreciation and a continued strong market that I just don't see anything like 2008 happening, certainly not up here in Anacortes or Skagit County. Our county fundamentals are fantastic. If you have any questions, please feel free to email me, text me, jump on www.anacortesrealestate.com and you can get in touch with us there. I hope everyone is home and safe and healthy and is practicing appropriate physical distancing, but staying in touch with people socially. Talk to you later.